Have you heard of different investments and wonder how much of each you should have? Well, in this episode, we will teach you all about determining the best asset allocation for you. Hello, and welcome to the Wealth Minded MD podcast with your money best friends. I'm Dr. Brittany Helford.
And I'm Dr. Alicia Taylor.
And of course, we're here to help you build wealth and make good money decisions so you can create the life you desire with more control over your time. Alicia, can we talk about one of the most important money moves we've made as doctors? And I don't know about you, but for me, when I think about this, it's actually insurance. Yes, I know it's not sexy, but it is absolutely essential, especially disability insurance.
Facts. I got mine right after med school, before residency even started. And let me tell you, Prati Botto at PKA Insurance Group made the whole process so smooth. He actually cared, broke down everything, explained the fine print, and got me the best policy for the best price.
And what I love is that he treats everyone like that, residents, attendings, even docs on visas. He literally got you. He's super responsive, super knowledgeable. And if there's a better deal out there, he will tell you.
Oh, and if you're healthy, you could get approved for up to 10 million in life insurance. So not just disability insurance in only 5 minutes. No labs, no hassle.
So if you're serious about protecting your income and your family, call 1-800-258-1018.
Or email pradeep at pkainsurance.com.
All right, Alicia, let's talk about what's going on over there in Atlanta. Tell us, give us a life is lifing update.
Yeah, so I actually have been working on a new presentation for some of our interns. In true academic and faculty fashion, the chief resident emailed me and said, Dr. Taylor, wouldn't you love to give a presentation to the interns this month? And I thought to myself, no, I don't mind teaching. It just takes time to prepare quality presentations. But, I'm a faculty member and I don't mind teaching. And so I was thinking, okay, it's their practice management sort of getting them together, electives month or whatever. So I was trying to think of what could I teach them that they could specifically benefit from. Because a lot of times when I'm teaching, it's like for the entire residency, all the different, third year, second year, whatever, or for the entire GME program. So what is intern specific for family medicine? And I thought to myself, okay, why don't I teach them how to manage some common problems in outpatient medicine or some common dilemmas that doctors kind of have to navigate in outpatient medicine. And as I was preparing this presentation, I was like, okay, I don't want too many words on the slide. I'm going to use photos and we're going to make this interactive. But it was interesting to me. I was kind of chuckling to myself as I was creating this presentation because some of the quote unquote problems or dilemmas is what do you do when you're in a patient visit and someone brings up 5 problems and you have 15 minutes? How do you navigate that? What do you do when they're coming in for a preventative annual physical, but they've also got like 5 problems that are very important to them? What happens if the patient is late and how do you address that and set boundaries, but still provide good care? And what happens when you're in the room and you completely draw a blank and you do not remember how to treat something that you should remember how to treat, just helping them kind of navigate this thing. So we will see how the presentation goes and how it is received, but hopefully they find it helpful.
Well, Alicia, I really commend you for saying yes. Similar emails sent to me. And I'm like, maybe in a couple of months. Don't ask me the specific month that you want me to give the presentation. Let me tell you my availability. And it's so funny because, to your point, when you're constructing a presentation, you want to ensure that it is a quality presentation, something that your audience is actually going to benefit from, and something that is in time learning right when they need it. So they're like, oh, yeah, I had this patient yesterday and I wish I would have had this presentation then. So that's how you want the information to hit. I remember responding saying, hey, I would love to, but right now I don't have the bandwidth. And they're like, oh my gosh, is everything okay? And I'm like, yeah, I'm just being very protective of my time and ensuring that, I have time to do my runs and have time to read books with my kids and spend time with my husband and do all the other things that I'm doing. So I love that you said yes and you've created some space. I just hope that the world opens up to create a little bit more space for me to do it. Cause right now, girl, I have not responded yet. My goodness.
No, I totally get it. I was chuckling with one of the former chief residents who's now an attending. And I was like, I don't think that sometimes the residents really understand how much effort it takes to create a quality presentation and how many other things we have on our plate. So to ask somebody to present to you in a couple of weeks is like, whoa, I'm gonna need a little bit more time next time. Let's try to ask sooner, ask my availability, give me some heads up. But that's okay. I was able to pull this together. I was like, okay, let me think about this kind of stuff. It's not like a deep dive into a medical topic that requires a bunch of research and all of that stuff. So hopefully they will still find this enjoyable. I try to take it in stride and say, okay, they must think I'm a decent presenter if they keep asking me to do this over and over again. So I'm like, okay, let me find the silver lining in this. And hopefully they'll find it rewarding and I'll get some sort of joy and pleasure out of helping them become better doctors. So we
Yeah.
shall see.
You will. One of your core values is generosity. So, being generous with your time. And oftentimes you see the payback, especially if they're interns and you a full fledged attending girl, you got a lot to share. They got a lot to learn. Awesome. Well, you'll have to let us know how it goes.
As physicians, one of the most important things that we can do is make sure that we secure our income because a lot of our financial plans are contingent on our high doctor income. One of the things that you will need to do is make sure that you get long term disability insurance.
Now, Pradeep and his team at PKA Insurance Group have a reputation for putting people over profits and always doing what's best. Do not hesitate to email PKA Insurance and his team today.
They will help you get the insurance you need with the service you deserve.
Being thoughtful about how you're allocating your time kind of takes us to the topic that we're going to discuss today, which is asset allocation. Now, we don't always think about our time as an asset. We think about our money as assets. But I think allocating our time appropriately and allocating our money appropriately kind of go hand in hand. I am super excited to get into this episode today. So, with asset allocation, what we're going to be breaking down for you is what asset allocation really means, why it matters more than just picking the right stock, what counts as an asset, and how to figure out what is the perfect mix for you. So, Alicia, usually you're the curious George between the two of us. So I'm going to pick your brain about how you are managing and allocating your assets. You ready to dive in?
Yeah, let's do it. Let's do it.
When I think about asset allocation, it is basically looking at your assets. So define assets for me is like anything that continues to build wealth for me, anything that has significant value that is going to continue to build wealth. So for us, we have assets as our homes, our assets. We have retirement accounts, of course, money that's assets. But some people might think of other types of assets, such as like gold, oil and gas investments are also assets. So it's anything that adds significant value and can return some of your investment is what I consider as an asset. So when we think about asset allocation, is basically the process of combining different asset classes within a portfolio. We'll break down specific types of assets and what they actually mean for you. So, Alicia, when you approach asset allocation, what are some of your big considerations? I have mine, but I'm curious to know like what is the top priority for you?
Yeah. So when I am thinking about, okay, there's all these different assets, as you mentioned, right? Oil and gas, there's gold. Some people like Chanel bags or Rolex watches. Other people like to invest in the stock market or real estate or what have you, right? So there's all these different choices that you have. And once you learn about these things, maybe you don't learn about all of them at the same time, but over time you start hearing about people investing in different things and acquiring different assets. You have this question of which one should I have? Which one should I invest in? Which ones might be good for me? And as I think and ponder that question, there are a couple of key considerations that I have. Number one, is will it increase in value over time? And how much might it increase? So I'm thinking about what's the return on my investment that I could get? I could purchase, I don't know, this fancy purse, and maybe it will increase in value over time and I could resell it. But the value that it might increase over time is a little uncertain. Maybe it could go down in value. Maybe that takes a little bit more effort or whatever. And so, I'm thinking about what are the different assets that could really increase in value over time to the greatest degree? What's my return on investment? Number one. Another thing I'm thinking about is How much time and effort does this take? Maybe I could start a business that grows into a multi-million dollar empire, but if it's going to cost me, 100 hours per week, maybe that's not the business that I want to invest in, right? If it requires 50 hours of research and comparing different things and making 20 calls and having 80 meetings, then it's like, okay, maybe that's just not the one for me right now. So, number 1 is return on investment. Number 2 is time and effort that it requires. Number 3 is risk. What is the risk not only that it could go up, well, what's the risk that I could lose my money? People come to me and say, "Hey, Leisha, you seem great. You're a good investor. What do you think about investing with me in this business? What do you think about coming in with me on this real estate empire?" I'm like, "Girl, I don't know you." There's a huge risk that I might lose my money. Things could go down in value. That is too much risk for me. Contrastly, I meet people all the time, especially females, who have all this money saved in a savings account and they haven't invested it because they're afraid of the risk, right? Because they're
Mm.
afraid that it could go down in value, right? So I'm thinking about, just to recap, number 1, return on investment. Number 2, time and effort. Number 3, risk. And then number 4 is more ease. Is more ease. And what do I mean by ease? I am a very busy person. And so for me, it is like, what is easy for me? What can I put on autopilot? When I think about investing in the stock market, oftentimes that's really easy for a lot of people because they already do that automatically through their job versus getting into another kind of asset like real estate or Bitcoin or whatever just requires more effort. Those are some of the considerations that I have. The last one I would say is, how much do I already have? What's the status of my portfolio, if you will? Am I someone who has a ton of student loan debt, a ton of credit card debt, a ton of other debt that I need to prioritize paying off before I invest in these assets? Or am I someone who's doing pretty good? When I made my own financial plan, one of the things that I was thinking about as I was determining asset allocation was, all right, when I hit this net worth, then I will start to invest in this type of asset class. When I hit this other net worth, then I'll add another asset class or I'll increase the percentage. And so for me, it's not I make an asset allocation at one time and I keep it for the rest of my life. It's like, okay, I'm going to invest in this way while I'm still building wealth, while I'm still trying to make sure that I'm financially secure. And then as I become more and more financially secure, as I become more and more financially well, then I can afford to take more risks. Then I can afford to increase my asset allocation to some of these other types of investments. And so those are the things that I'm thinking about: return on investment, how much time does it take, how much risk is involved, how easy is it for me, right? Is it passive? And then the fifth thing, like I mentioned, is how much money do I currently have? What's my current financial status? And can I afford to make this kind of investment at this point?
I think you said some great things. So, one of the things that I just want to highlight here in what you said is that your asset allocation is personal. Your asset allocation is going to look completely different than my asset allocation. So, as you're listening to this podcast, when Leisha and I reveal kind of how we think about our asset allocation, don't feel a certain way because it really depends on you. It really depends on your lifestyle. It depends on your goals. It depends on your risk tolerance, as Leisha has highlighted. So everybody's asset allocation is going to be different. And that's why I think the first thing that I like to prioritize is, what are my goals? Like, what are my short term goals and what are my long term goals? And how can I design something that's going to get me there today and tomorrow? Something that's going to get me there, whether it's sunshine and rainbows or it's stormy weather for 12 days and I'm praying for just a glimpse of the sun. This is really important that you highlight and you really understand what your goals are and not have a myopic view of what the situation is or just trying to keep up with the Joneses or the fads. Really be clear on, how much do I need now in order to have enough joy, in order to achieve my today goals? And how much will I need in retirement in order to have enough joy and achieve my goals in the future? And once you can clarify exactly what your goals are, then you can create a pathway with your asset allocation in your financial plan to get there. And Leisha, when you talked about risk, risk has a couple of components. It has your risk tolerance, meaning that in the 2020s during the pandemic, when things were low, bear markets, the S&P 500 dropped 20%. Can you weather the storm? Can you stay put and secure in your financial plan, even though you have lost significant amounts of your assets in that asset class? Unfortunately, most people cannot. Unfortunately, a lot of individuals, because money is tied to our emotions, sell at the bottom instead of purchasing more. Personally, I can say that a family member of mine sold some of their investments at the bottom because they were unable unable to tolerate the risk emotionally. And then they also did not have the risk capacity, which means that if you have $8 million dollars and you lose 20% of that, you're like, okay, I'm good. It doesn't matter. Like, I can stick with this plan. But if you only have enough to survive your retirement, you don't have any excess and you're pushing that margin, then losing 20% can be detrimental. So we really want to understand our risk and understand not only what is our risk tolerance to weather the stormy weather, right, to stay put, but also what is our risk capacity. And this takes me to this third tenet that I think about is the time horizon. And oftentimes we think about time horizon as age. I'm a little older than you, but I'm still young. I consider myself a spring chicken here. So I'm like, investments, do what you do because I don't need you anytime soon. But let's say that I am still pretty young, but I desire to retire early. Then my time horizon is actually quite shorter than what it would be if I worked a full career. So that is one, the factor of time needs to be incorporated into these decisions. And then lastly, I think preferences. You mentioned the time you're going to spend. How hard is this thing? Shoot, I got to do all this work for this. Oh no, I'm just going to invest in something that is easy. So really understanding what are some of your preferences? How does your investment strategy align with the flow and the function of your life? How does your investment strategy align with some of your goals, your core values, and what is important to you?
Yeah, I agree with that. And I love that you said starting off with your goals. And I think that that will give people a lot of direction. Oftentimes, we can get caught up in comparing ourselves to other people, comparing how we're investing to other people, how much money we have to other people. But I think it's important for us to take a step back and say, okay, they may be playing a different game than we are. They may have different goals than we do. They may have a different time horizon than we do. And that may dictate the way that they invest, the way that they save money, the way that they spend money. Really kind of understanding that we need to keep our eyes on our own paper, if you will, and come up with our own goals. And I think that that will really help shape how we invest and how much money we invest. So I really love that you brought that up. As somebody is thinking about this, Brittany, let's say we've got a person who's a physician who's like, all right, Brittany and Alicia, I really want to start investing. To be honest, I haven't really invested much on my own. Yes, I contribute to retirement accounts, but to be honest, I'm not even sure how that's invested. So, how should I be thinking about this? What is a good way to get started? What kinds of asset classes did you two start with? So, what kind of advice would you give somebody who's kind of just starting on this journey?
Yeah. So, one of the things that I would say is what type of investor do you want to be? You may not know, but you need to sit with it and look at how you operate in other facets and domains of your life. So, for example, if you don't know how to do something, are you someone who like jumps all in, does the research, like, okay, I'm going to figure this thing out? Or are you someone who doesn't know how to do something and you're like, okay, I'm going to hire somebody to help me to learn how to do this thing so that I could do it more efficiently and do it myself in the future? Or you're like, I don't know how to do this. I'm going to stick to my zone of genius and I'm just going to pay somebody to do this thing for me. And I think that when you can really clarify where you fall in that, then that will help you to understand what your strategy could be. Because if you are the person who wants to do it all yourself and kind of figure it out over time, then I think a really great place to start is to use your employer's 401k and also start to understand what is a target date retirement fund. So, Alicia, I know we talked about this before. You had actually a really good breakdown of all of the different asset classes in the target date retirement fund. I don't remember them exactly to the T, but if you do, then feel free to let us know here. Like, what is the typical asset? I know how they adjust, right? So they do like 110 minus your age, and that's going to be the amount of stocks. But I don't remember the exact distribution between domestic stocks versus international stocks, and then also bonds, and they keep a little bit in cash. Do you remember how they break down the international, domestic, and bonds?
Yeah, so target date retirement fund is usually the default option at most employers, which I think is why you brought it up. When you have money invested in a target date retirement fund, so when you allocate money to your work retirement accounts and you haven't chosen how you want that money to be invested, usually it's invested in a target date retirement fund. And to answer your question, Brittany, each one does it a little bit differently, but I think for the vast majority of them, the general gist is the same. And that is dependent on your age or your target date of retirement, right? And so if your target date of retirement is 25, 30 years away, then usually it's going to be invested quite differently than if your target date of retirement is much closer. And it's not like you tell them what your target date of retirement is. They just choose the year in which you're going to turn 65, since they feel like most people retire at age 65. For someone who's quite young, let's say you're 30 years old and it's going to be 35 years until you turn 65, then usually the asset allocation is 90% stocks and 10% bonds. And then that asset allocation will change by about 5% every 5 years. So if you're 35, then maybe it'll be 85% stock and 15% bonds. If you're 40, maybe it'll be 80% stocks and 20% bonds, and so on and so forth. Now, I think your question, Brittany, is okay, even if it's 90% stocks and 10% bonds, what is that 90% stocks made up of? So, when you invest money in a target date retirement fund, they're not actually investing your money in individual stocks. It's basically a group of index funds. And member index funds are a group of stocks. So, the most common index funds that are inside of a target date retirement fund is the total United States stock market index fund. So that invests your money in all of the public companies in the United States. Another index fund that's in the target date retirement fund is the total international stock market index fund. So that invests your money in international stocks from around the world. And so usually the stock portion of the target date retirement fund is made up of those two index funds. Part of it is US stocks, part of it is international stocks. And usually that allocation is 60-40. So 60% United States stocks. So in this case, it would be 60% of the money and the target, 60% of the stock portion of the target date retirement fund would be invested in the total United States stock market index fund. And then the remaining 40% of the stock market allocation would be invested in the international index fund. Same thing with bonds. They do total United States bonds and total international bonds. And so those are the four most common index funds, right? Total United States stock, total international stock, total United States bonds, total international bonds. So those are the four most common index funds that are inside of that target date fund. So hopefully that makes sense and I didn't confuse people, or if I did, I'm sure you can clarify for them.
No, you didn't. I appreciate that. Yeah. I couldn't remember the exact breakdown, the allocation to each domestic versus international. As you're listening to this, one of the reasons why I recommend a target date retirement fund is because it helps you to conceptualize what your risk will be as you approach your retirement. I mentioned someone who's a bit older sold during the pandemic, and that was because their risk capacity was lower, their time horizon was a lot shorter. And so the target date retirement fund has someone who does that for you. As you near retirement, your investment portfolio, your asset allocation becomes more conservative, allowing for you to weather the storm better because you have more protection with more conservative allocations. And I think that this is a great place to start because you don't necessarily have to do all of the figuring out, the choosing of the things yourself. And it also allows for you to have diversification and allows for you to have the protections that you'll need as you move forward in your retirement. But as a DIYer, you can choose different dates. As Leisha mentioned, it depends on when you want to retire. And so you can choose, maybe that you're 30, but you're like, okay, well, say if I act as if I'm 20-year-old, and that way I can make my portfolio a little bit more aggressive and expand that time horizon, but still have someone to do the things for me. That also gives you an idea of what an asset allocation could look like for someone who wants to have this transition. And so you can start to learn what are those exact index funds that you're choosing within this entire fund that is designated for me. So I think that's a really great place to start. If you're someone who's like, okay, well, I want a coach to kind of help me to do this, then you can meet with a be only financial planner and discuss what your goals are and kind of set some things up. But as for me, like I fall into probably the DIY and the financial planning, meet with somebody, talk to some people, figure things out. For us, we wanted to have a little bit more latitude and flexibility than a target date retirement fund. We also wanted to add some real estate into the mix. We wanted to add some businesses, oil and gas, and other things into the mix. And so if you are someone who wants to add that in the mix, then what you can do is to think about, okay, I'm still very young, so I still want to be very aggressive. Let me make the majority of my portfolio, choosing whatever percentage you want to choose, 70, 80, 90%, the majority of my portfolio stocks. And then I could choose maybe a little bit of bonds or no bonds, depending how old or young you are, depending on all the factors that we discussed, and then have a portion of it for the other category where you can add in in the real estate, add in, some oil and gas, etc. And then if you're someone who just wants to pay somebody to do it for you, we have a whole episode about how to vet your financial advisor, meet with someone and talk through your goals and have them to kind of just do it for you. So that's kind of where I would guide people depending on their personalities. And I would also say that if you fall in the DIY bucket and you're like, I actually want some help, you can always transition through these different categories. There was a time in which we just paid a financial advisor and now we're more DIY. So you can mix and match and kind of flow between the various categories.
I like that. I like that. And I like how you were mentioning that for somebody who is getting started, who maybe hasn't been investing as long or doesn't feel as comfortable investing on their own, then maybe just getting started through your work retirement accounts is a great place to start. And I totally agree with you. The easiest kind of investment to get started in is the target date retirement fund. That usually is the default option at most employers, but just make sure that that's the case at your employer, right? You don't want the money just sitting there in a savings account, not earning much interest. And so just make sure that your money that you allocate towards your work retirement account is actually being invested. And if you are not sure, email HR, just ask them, hey, I just want to reach out to you. I know that I'm contributing to my work 401k or work 403b. Can you ensure that my money is actually being invested? Is there a default investing option? What is the default investing option? Is it some sort of target date retirement fund? Just ask your payroll, ask human resources. They'll be able to answer that question for you. So I think that's a great place to get started. And Brittany, it seems like you and your husband said, yeah, we're going to start there, but now you've changed things, right? As you've acquired more wealth, as you all have decided to increase the number of assets that you're investing in. You mentioned that now you all do oil and gas. Now you all do real estate. Now you all are starting other business ventures. And I think that that's great. Only issue I think is that people are listening to this and they're saying, should I be doing that too? Some of the questions and some of the things that I think you should consider maybe before branching out into other asset classes is what is the cost to actually get started in that asset class? And do I have the knowledge needed to invest efficiently without losing all of my money? And I think those are two key things, right? As people start to get invested or start to get started in real estate, or as they're thinking about oil and gas, or as they're thinking about buying new businesses, those are some of the things, in addition to what I mentioned earlier, that I'm thinking about is when you get started in the stock market, you can get started with $1. $2. When you get starting in real estate, oftentimes you're not paying for the full cost of whatever form of real estate that you're purchasing. You may need to get a mortgage from a bank. You may need to invest your money with other investors. You may need to do a bunch of research. And so it just requires a lot more knowledge and it might require a substantial amount of upfront money or cash. And so do you have that upfront money or cash? Do you have the knowledge that you need? And then the other thing, Brittany, I think is something that you didn't mention, but I'm sure that you and your husband consider, and that's the tax treatment. As we're physicians and we're already in a high tax bracket, we're not only thinking how much money can we make on these investments, how much money can we make off these assets, but how much money are we keeping? Because the taxes are a little bit higher than maybe we might like. And so, yeah, you might be making a ton of money, but if you're also paying a good portion of that in taxes, what amount is left over? So it's all about efficiency, right? How can I keep more of the money that I'm making? Which assets might be better from a tax perspective as well?
I love that you mentioned the taxes. That's where my brain is always just trying to make it work. With our asset allocation, I completely agree with you. Our strategy has evolved a lot as we have grown in wealth because of the capital that is required and also the risk. So it's like, okay, we have a little bit more risk capacity now. And as we start in a new asset class presents new opportunities, but then it also presents other problems that I have to solve around. When we invested in oil and gas, that presented an opportunity for tax savings and it presented an opportunity for diversification, but it also presented a problem. Now I have this passive income that I need to figure out how to offset that. Otherwise, I'm just going to pay ordinary income on the passive income, So maybe I should have just kept it in the stock market or in a retirement fund where maybe I wouldn't have had to pay the taxes on it. So I think as you are navigating this, it is really important that you think about the tax treatment. And I really appreciate that you brought that up. I think we should do a whole episode about asset location as well, because that's where the taxes really come into play. And it requires a higher level of understanding. So we don't want you to jump into the deep end with this. You could have a reasonable portfolio and do exceptionally well, have the life that you desire today, have the life that you desire in retirement by just investing in stocks and bonds and keeping the stuff simple. Studies show that over 90% of your investment performance actually comes from asset allocation. So it's not about picking necessarily the right investment. It's about ensuring that you can do all of the things that we talked about, that you understand what your risk tolerance is and that you can weather the storm, that you understand how this asset allocation is going to get you to your goals, and that you understand some of your preferences. And there are so many paths to wealth. It really does not just depend on, oh, I want to be a real estate mogul and I want to do all these fancy things. You can keep everything simple and still accomplish your goals. So I just wanted to put that out there. Another thing that you said, Alicia, that I want to get your perspective on, because I see this very often, is that people are so afraid to invest. So they're putting the money away and maybe the employer's not doing it for them and the money is just sitting. I know a family member who's like, oh, I didn't have it invested. I was scared to invest. I'm like, okay, so you might have avoided some risk with the volatility of the stock market, but now you're accepting other risk. You're accepting inflation risk, accepting your money not growing. And so I just want to talk through that a little bit because there might be some people who are like, okay, I'm just going to be super conservative. I'm 20 years old. I'm 30 years old. I just want to be super conservative because I don't want to lose money. Can you talk through some of the pros and cons of that decision?
Yeah, I mean, you want your money to grow over time and grow enough so that one, you're keeping up with inflation, right? Things get more expensive over time. And so if you're not investing your money, you're losing purchasing power because things are going to get more expensive over time. So you need the money that you do have to keep up with inflation so you can continue to have the same standard of living. So that's number one. Number two is that you need to invest money so that it can grow more. A lot of us may not be able to reach our financial goals, may not even be able to afford to retire if all we do is save money and we don't invest money. So you have a desire to stop working at some point. If you have a desire to afford to send your kids to college, to be able to build wealth, be able to cut down to part-time, a lot of these financial goals you have, they require that you invest money because simply saving money is not going to get you there. If we could all reach our financial goals without taking any risk, why would we invest? That makes a good point, right? If I could reach all my goals by just putting money in a savings account, I don't know if I would invest. But the problem is that I can't reach my goals by just saving. So I have to take some risk. So it's like, all right, would I rather take zero risk and have my money in a savings account, but then not be able to retire, not be able to send my kids to college, not be able to do the things I want to do? Or am I going to understand, like, okay, I'm willing to take some risk so that I can achieve these goals? So, one, I think taking some risk is necessary. The other thing to keep in mind is the kind of risk that you're taking. Yes, from day to day, month to month, and maybe even from year to year, the stock market could fluctuate in value, right? Things go up over time. Sometimes they can go down over time. So you might notice that if you log into your investment accounts one day, maybe they're one value, and the next day you log in, they're a little bit lower. The next day you log in, it's back up again, right? So it fluctuates, it changes a lot, and that can scare people. But over time, when you look at 10 years down the line, 20 years down the line, 30 years down the line, it goes up. And so although you might be afraid of losing my money, understand that as long as you didn't sell those investments, you haven't actually lost money yet. It might go up over time. In fact, it probably will. You don't have to be as worried about, oh my gosh, I'm worried I'm going to lose my money. Well, if you don't need the money until you retire, and that's 10, 20, 30 years away, then you're probably not going to lose money, right? In fact, we're going to gain a lot of money. And so I think when people think about it like that, like, okay, Alicia, you're telling me that the stock market goes up over time, even though it may fluctuate day to day, it's going to go up over time. And that's what I want. You're telling me I actually have to invest if I ever want to be able to retire. And you're telling me I need to invest in order to even keep up with inflation. Okay, Alicia, this makes more sense. So that's kind of how I approach it for people who are a little nervous to get started.
I appreciate that you talk them through this because honestly, you and I are both African American. I think for our culture, historically, the message has been save, 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 and it has not been investing. And unfortunately, it's led to our detriment. So I talk about investing with Brooke, this is why you need to invest. It's really important. So if you're someone who has fear of investing, then I definitely would encourage you to kind of be part of that cohort of people who uses your employer 401k and you put in a target date retirement fund and then start to look at it when it drops. How do you feel? Don't make any changes, but just really tap into your emotions so that you can build up that risk tolerance because you know what they say, go big or go home. And so we want you to go big, but of course we want you to do so in a way that feels comfortable for you, in a way that feels safe, and in a way that is strategic. So talking about all of this, one of the things that that is a key principle of asset allocation and why this is so important is because of the diversification. So, Alicia talked about with a target date retirement fund, you have a portion of your money that is in stocks or equities, you have a portion of your money that is in bonds. That allows for some diversification. And then within both of those categories, you have further diversification. So when we think about diversification, though, it helps to reduce your portfolio volatility without reducing the potential returns. And one of the key components of diversification is ensuring that the assets are not directly correlated. So let me give you an example for this. So if you have the S&P 500, which is like the top large cap companies, 500 large cap companies within the US that are on the public US stock exchange, and then you have the total US stocks, you might see that there's some direct correlation because those large capital companies are such big hitters. They make up a large proportion of the total US stock market index fund. By adding both of those doesn't really add that much diversification to your portfolio. So you want to ensure that they're not directly correlated. So that's why she said stocks and bonds. And in that stocks category, we highlighted domestic stocks and international stocks because they are not a one-to-one correlation. They might have a little bit of overlap, but they are not directly correlated. Alicia, when you're thinking about diversification, are there any other principles that you incorporate into conceptualizing the diversification of your asset allocation?
I think that making sure that they're not directly correlated is really important. Another thing that I consider is just what am I interested in? There's a lot of different choices. And sometimes it's not that one is bad. It's just that I'm not interested in that. A lot of it is like, okay, what do I want to invest in? What kind of tickles my fancy, if you will? When I'm getting started and when I'm helping people get started, usually I say something along the lines of there's a lot of different choices. I usually tell people that if you don't have as much time and you are employed somewhere full time, then why don't you start in the stock market? Because it's easiest to do that through your work retirement accounts, through your 401k, 403b. If you just invest in there, usually, as I mentioned, the default is a target date retirement fund, which is going to have your money invested in a bunch of stocks and some bonds. And so, therefore, you're in kind of invested in that. Now, if you're investing outside of your work retirement accounts, let's say you've got a Roth IRA, for example, or you've got some sort of taxable brokerage account that you're going to invest money through, or maybe you just got extra money that you can use to invest after you've contributed the maximum at your job's retirement accounts. Now let's start to think about this thing, right? Usually what I say is some equivalent of let's use some general formulas here, 120 minus your age, 110 minus your age, 100 minus your age. Let's use those general formulas to help give you some sort of direction on how to get started in terms of the percentage of, let's just call it riskier investments. So if we're using the formula of 120 minus your age and you're 30 years old, for example, 120 minus 30 is 90. So 90% you can afford to do in stocks and more riskier investments. And then 10% probably needs to be in bonds, something stable. If you're 40 years old and you're using that formula, right? 120 minus 40 is 80. So maybe you do 80% in stocks or riskier investments and the remaining 20% in bonds. So that's kind of how people get started, or how I usually advise that people get started. And for a lot of people, it's like, I want to keep it simple. I only want to do stock market. So I'm going to invest that 90%, for example. I'm going to invest it all in an index fund or target date retirement fund or whatever it is. And I'm like, great. And that I think is good for some people. Now, as people start to accumulate wealth, or maybe they are very interested in other things like real estate or Bitcoin or businesses or oil and gas, then I start talking about, okay, those are what I consider to be alternative investments. And when it comes to alternative investments, sometimes they can be a bit more risky, especially if you don't have a ton of knowledge in that area, you're not an expert in that area. And so I usually advise people, maybe let's start small. Maybe let's start with like 5%, no more than 10% in those alternative investments, right? And so if you're 30 years old, 120 minus 30 is 90%. So okay, I can put 90% of my money in some sort of risky investment. Okay, maybe of that 90%, 85% is invested in index funds. And the remaining 5% you can put in alternative investments like real estate or Bitcoin or commodities or whatever, and just see how that goes, right? Do that for a couple of years. Make sure you didn't lose all your money, learn a little bit more. And then you can say, okay, I feel more confident in this. This is working out for me. Maybe I increase that percentage to 10% and I see how that goes. And if it's continuing to grow and you're like, hey, this 10% is outpacing the others, then you can start, in my opinion, increasing that percentage. And I think this happens a lot for people, especially who invest in real estate. Unless you grew up in real estate, you have a ton of knowledge of real estate. Maybe you want to start small, right? Maybe you start with a rental property, an Airbnb or something like that. Or maybe even you just start with REITs, right? Real estate investment trust, which is like a real estate based index fund. Maybe you just start with that. Start simple, start slow. see how that goes. And as your wealth increases over time, as you get more comfortable, then I think you can increase the percentage that you allocate to those alternative investments. So that's kind of how I think about things. Brittany, what do you think about that?
Yeah, I love that approach. And honestly, that's the approach that we've used the last time that I went through our asset allocation. Because, okay, let me start with the financial plan piece. The financial plan piece, I did not have built in oil and gas. I did not have built in real estate or acquiring businesses. Like at the point of deciphering our financial plan, that just wasn't on my thought. Like it wasn't on my mind. It wasn't something that I was aware of and knowledgeable about. I say that to give everyone permission to grow and to change. But when you change, you understand that you're changing not out of emotion, that the stock market is down and you're seeing the volatility, the ups and downs. And so now you're selling all of your stocks and you want to move into bonds because of that emotional change. You want to be able to make the change to really think about it and say, okay, this is where we are now. 110 minus our age, so we're approaching 40. That's where we are. We're approaching 40. So we're having to make some adjustments. And it's understanding where are we right now and how do we want to adjust strategically, not even looking at how the investments are doing, just really understanding what our goals are. So with that, we were mostly in target date retirement funds. We were also in just stocks and bonds. And we started to add on some of the alternatives. So for us right now, we are 70% stocks, 20% in bonds, and then we have the 10% that we have in alternatives investments in oil and gas, real estate, and then also right now we're investing in a business venture. My husband asked me recently and he's like, "Hey, do you want to do oil and gas again?" And I'm like, "It has a lot of tax benefits, but actually looking at our portfolio, I don't want it to be too heavily weighted in oil and gas." So I think for the sake of, again, diversification, that we probably should hold off on contributing to this until, our portfolio grows a little bit so that we're not too heavily weighted in one specific area that is undesirable. So this is why it's important for you to check in on your portfolio, your asset allocation, I say once or twice a year, and just to make sure that everything is on track with your goals, that nothing has shifted, and to also ensure that one asset allocation has not become heavier than you actually desire it to be.
Yeah, I love that. I love that. And I love the fact that you said that as and your husband realized you're getting a little bit older, not as young as you used to be, you started thinking about, okay, what are some ways that we might want to alter the way we invest? And I love that when he asked, would you like to invest more in this thing? Right? You're like, okay, hold on. Let's make sure that we've got good diversification and that we don't have too much of our investments into this particular more risky alternative investment, right? Because you still probably have some sort of target amount. I think you mentioned 70% that you want in stocks, right? And so let's say, okay, this is doing well. But again, our goal was to only have 10% in these alternative investments. And right now we're at that mark. So let's hold still for right now. And as we continue to make more money over the years, then we'll have even more money to invest and we can reallocate that new money to the different portions, right? If the stock portion has gone down below that 70%, then maybe we put some more money in stocks. If the bond portion has gone below that target of 20%, then maybe we put some more money in bonds. If the alternative investment has gone below that target of 10%, then maybe we put some more in alternative investments. If everything is already where we want it to be, right? We already got 70% stocks, 20% bonds, 10% alternative investments, things are moving, then okay, whatever the new money is that we have to invest this year, whether it's 50,000, 100,000 or whatever it is, then let's just invest it accordingly. Let's put 70% of that new money in stocks, 20% of that new money in bonds, and 10% of that new money in alternative investments. So honey, I don't know about oil and gas. We got X amount of dollars. Do with it as you will. I love that approach and I don't know if I'm putting words in your mouth, but it seems like that's how you all are doing it. And I think that that's great. I think other people should follow suit. Maybe they might have different percentages. Maybe somebody is
Mhm.
listening to you, Brittany, and said 10% alternatives. I need to be building up my stocks. Okay. So maybe they are putting all that money in stocks. Or maybe somebody is listening to you and saying, I like Brittany's approach of 10% alternatives, but maybe they're really fascinated by Bitcoin, or maybe they're really fascinated by collectibles. Maybe they like to purchase art paintings or fancy purses or Rolex watches, and people have different values and ways that they want to invest. Maybe somebody heard you say 10% alternatives. All right, I'm going to the Chanel store. It really just depends on, what your interest is, as I mentioned. But I think the point is we want the bulk of the investments to be on what we call kind of safer investments, which is kind of that percentage that you have in stocks and that percentage that you have in bonds.
Alicia, I love that. And it's so funny. You gave people permission to spend on what they love. And that's what at least the 10 10%, the alternative bucket, that other, it allows us to have a little freedom and flexibility. The 90%, the 70% stocks, the 20% bonds, of course, as we get older, we'll adjust and maybe increase our bonds a little bit. That's going to get us there. And now let's see what else we can do. Now let's have a little bit of fun. Let's, test our hand, try some things out and learn. And that's what the 10%. Maybe for you, it's going to be 5%. Maybe it's going to be 2%, whatever it might be. But that gives me a little bit of freedom in how we're investing our money. And when I say fun, like I'm not a stock picker. I know some people are, but maybe that is going to be okay. This is a 2% that I can use to like trade stocks, if they want to do that. Okay. I have the rest in these stable index funds that are diversified. And now I want to trade a little bit. So here, maybe I want to do options, whatever it is for that small portion that gives you some freedom and flexibility. Well, speaking about fun, let's learn about how you are spending your money for fun.
Yeah, so I am going to New York this weekend. So that's how I'm spending money for fun. And I'm so excited. I love sports. And so I'm going to catch a WNBA game because I love basketball and going to catch a baseball game. So I'm excited about that. It was so funny. I am going to New York. And then one of my friends and her husband is actually going to New York as well. And I was like, oh my gosh, maybe we should double date. Do you want to meet up in New York? And she was like, I would love that. But I don't know if my husband will because I think he thinks it's like a couple's trip. And I was like, all right, it's fine, it's fine. But I'm just saying that to say that I'm excited about this trip to New York. We're going to do some fun things and eat at a fancy dinner. And I mentioned going to different games and maybe we'll hit up and go to a Broadway show or comedy show or something like that. So I'm excited, even more excited that I got this notification from Delta that my flight had been upgraded for free. Shout out to airline status. Nothing like paying for the cheap seats and getting upgraded for free into the nice one. So I am excited. Gonna catch that flight this afternoon. Maybe have a little glass of wine on the plane or a little champs or something since I'm sitting in the nice seat. So we shall see. But that is something fun that I'm doing with money this weekend.
Love that for you. I think I've only been upgraded once, and it was at a point in time where I was younger. I was like in college and I got upgraded, and I was like, okay, yes, I will have a champagne flute or whatever it is that they give you. I don't even think I drank all of it, but just to have the experience since I was in first class, definitely could not have afforded to be there. So kudos to status. I am super excited. I hope that you have a really great trip. I have been to New York a bunch of times because my husband's from there, of course, but still haven't done all of the touristy things. So I have to like go to New York and be a tourist, instead of being, oh, I'm visiting family and have those experiences. So as always, I appreciate the itinerary. Take notes so that we can go and see all of the things. Like you, I am also going on a trip. I'm going to Martha's Vineyard. And I may have mentioned this before. My husband, he wears a bunch of different hats, but one is that, he's on a couple of boards. And so now they are engaging donors and they want him to come out. And he's like, okay, great. My wife will come with me. And we were struggling to find some childcare. And he's like, hey, do you want to take the kids? I'm like, okay. When you take kids to a trip, it requires a bit more coordination. But similarly, we learned that our friends from the church who also have kids will be in Martha's Vineyard the same week. So we're like, okay, great. Now our kids can kind of have like playtime. It will be great, especially it's on someone else's dime. And similar to you, he called and he's like, oh, I just want to double check the room that we're in. She's like, oh, well, we have an opportunity for a free upgrade. He's like, yes, please. Upgrade us to the suite. So I'm glad that our travel is kind of on the same vibe here. Yes to upgrades, yes to seeing other friends in different places, and yes to just taking some time to enjoy ourselves.
Yeah, this is going to be great. We'll have to report back. You're getting hotel upgrades. I'm getting airline upgrades. I am wishing and speaking into existence that both of us will get both upgrades in the future. So we love that. We'll have to do some more travel episodes on status and upgrades and things like that in the future. But hopefully our audience was able to take something away from this episode and get a glimpse for how you and I approach asset allocation. As always, if you have any questions, feel free to email us at wealthmindedmd@gmail.com. And again, we can't wait to come back to you again next week.
Hello. Hello, and thank you for listening to our podcast. And because of that, we have something for you, our Wealthy Minds Blueprint.
Have you ever thought to yourself, I wish I could be better with money? Do you want to start investing and saving for retirement, but keep delaying because you don't know where to start? Our Wealthy Minds Blueprint is here to help.
This guide will teach you what you didn't learn in your training so you can stop being confused about money and start taking what we call wealthy minded action.
We'll help you become a master of your finances and simplify investing so you can get started today. Take control of your financial future by downloading your free copy of the Wealthy Minds Blueprint now and start building the wealth you deserve.
One of the most important things you can do is ensure you have long-term disability insurance. Long-term disability insurance secures your income if the unexpected happens and you are unable to work due to medical illness, chronic conditions, or an accident.
Unfortunately, all insurance agents aren't created equal. Some of them are so focused on making a sale that they fail to reveal certain necessary information, tell you about discounts available, or clearly explain the process. Prati Botto and his team at PKA Insurance Group are different. They have a reputation of putting people over profits and always doing what's best.
If you need life insurance or disability insurance, reach out to Pradeep and his team today. They will help you get the insurance you need with the service you deserve.
Hello, everybody. It's me, Brooke. I'm recording a little disclaimer for my mommy, Dr. Brittany Halford, and her friend, Dr. Lisa Taylor. Just so you know, they're not financial advisors, tax professionals, lawyers, or financial planners. Everything you hear is for education and entertainment. It's not strict financial advice, you know. So use your best judgment, chat with a tax professional, and all those other people that you need to talk to. Thanks for tuning in today. Keep cruising on your journey to wealth and wellness. Bye-bye.